Assalamu alaikum. So this is the first lecture in the series of video lectures for chapter number 12, valuing mortgage-backed and asset-backed securities. In the last two chapters, chapter number 10 and chapter number 11, we have discussed in detail the working and the designing and methodologies of both the mortgage-backed and asset-backed securities. In this chapter, we will look at how they are priced. We know, for example, that a support range in a CMO structure has a greater prepayment risk than a planned amortization class range. However, what do we determine whether or not, or how do we determine whether or not the price of at which a support range is offered in the market adequately compensates for the greater prepayment risk? So in this chapter, we will describe and then apply a methodology of planning mortgage-backed securities and valuing mortgage-backed securities and some type of asset-backed securities. And obviously, we will do this using the Monte Carlo simulation. Remember when we discussed the valuation, we discussed this Monte Carlo. When we actually discussed the valuation of option embedded bonds, we discussed this. We will also see that how the option adjusted spread for a mortgage-backed or asset-backed security is computed and applied. So remember the option adjusted spread we discussed in the previous chapter, specifically in chapter number 6. From a valuation model, the effective duration and effective convexity of any security can also be computed. We will also see how to compute that from a Monte Carlo simulation. However, in the case of mortgage-backed securities, there have been several alternatives measures to the duration and convexity for the practitioners, used by the practitioners. And we will identify and discuss advantages and disadvantages of all these measures. So the main thing when we discuss the valuation is we have discussed for the simple straight bonds and option embedded bond is to analyze the yield, which is the yield analysis. For the market-backed securities, we referred it as a cash flow yield analysis. So the yield on any financial instrument is the interest rate that makes the present value of the expected cash flows equal to its market price plus accrued interest rate. But when applied to mortgage-backed and asset-backed securities, this yield, we refer it as a cash flow yield. The problem in calculating the cash flow yield of a mortgage-backed and asset-backed security is that cash flow is unknown because of the prepayment. So there is uncertainty regarding the cash flow of mortgage-backed as well as asset-backed securities. So what we do is, in order to determine cash flow yield, we make some assumptions about the prepayment rate, as we already discussed. And in the case of agency mortgage-backed securities, assumptions were also we do not need any assumptions about default and recovery rate for the agency mortgage-based securities, but for the non-agency and asset-backed securities, we also need assumptions for the default rates as well as the recovery rates. The convention, the market participants convention is to compare the yield on mortgage-backed and asset-backed securities to that of a treasury open security by calculating securities bond equivalent yield. And we remember how to calculate bond equivalent yield, right? We will revise in a bit. So as we discussed in chapter number 6, the bond equivalent yield for a treasury open security is found by doubling the same annual yield to maturity. However, it is incorrect to do this for a mortgage-backed or an asset-backed security because investor has opportunity to generate greater reinvestment income by reinvesting more frequent monthly cash flows, right? So it will be inaccurate just to double the yield, right? So what we have to do is that to calculate yield is such to make it comparable to the yield of maturity on a bond equivalent basis, we annualize the monthly cash flow yield for a monthly pay product using this formula. So what we do is we double it, but we use this compounding, or you can say the monthly compounding, right, for 6 months, and we then just double it. So we will get a bond equivalent for this. So it is calculated in the same way as we calculate the yield to maturity, except that we need to make assumptions about two things. One, prepayment rate, and second, if it's a non-agency mortgage-backed security, we also need assumptions about default and recovery rates. So now, what are the limitations of cash flow yield measure? All yield measures suffer from the same problem as we already discussed, that the yield to maturity has two major shortcomings. One, reinvest the coupon payment at the rate equal to the yield to maturity, and hold bond until the maturity date. So cash flow yield also have these shortcomings, that the project cash flow are assumed to be reinvested at the cash flow yield, and the mortgage-backed and asset-backed security is assumed to be held until the final payout based on the prepayment assumption. The importance of investment risk, the risk that the cash flow will have to be reinvested. So the reinvestment risk is particularly important for the mortgage-backed and asset-backed securities, because now the payments are monthly, and both interest and principal must be reinvested at the cash flow yield. So it's the reinvestment assumption is more crucial for these kind of securities as compared to when we discuss it for the bonds. Also, an additional assumption is that the project cash flow is actually realized. If the prepayment default recovery experience is different from the assumed, then the cash flow yield will not be realized. Right? Okay. Remember, we also discussed, when we discussed the yields, we discussed the concepts related to nominal spread. So the nominal spread is the given the computed cash flow and the average life of a mortgage and asset-backed security based on some prepayment default and recovery, we can then compare the yield to the yield of a comparable treasury security. The comparable treasury security obviously is of the same maturity as the security's life, and the difference between the cash flow yield and the yield on that comparable security is called the nominal spread. So the nominal spread is basically the difference between the yield of the security of interest, any mortgage-backed or asset-backed security we are interested in, as compared to the yield on any comparable treasury security. Unfortunately, however, it is a nominal spread that managers will use as a measure of relative value. However, this spread masks the fact that the portion of the nominal spread is compensation for accepting prepayment risk. For example, CMO support tranches have been offered at large nominal spreads. However, the nominal spread embodies the substantial prepayment risk, which means it does not compensate you for the prepayment risk. The manager who buys solely on the basis of nominal spread maybe fails to determine whether or not that nominal spread offered adequate compensation given the substantial prepayment risk faced by the holder of the support tranche. So remember, support tranches have a greater prepayment risk. So if you are analyzing solely on the basis of nominal spread, then maybe it is not a good idea. Instead of nominal spread, manager need a measure that indicates the potential compensation after adjusting for prepayment risk, and that is done by option adjusted spread. We will be focusing and discussing this option adjusted spread in detail, and we have also discussed this for the embedded option bonds in our chapter number 9. When we discuss in chapter 9, where we covered the valuation of corporate and agency bonds with embedded option. Before discussing the measure of structured product, we describe another spread measure commonly quoted which is the zero volatility spread. So what is the zero volatility spread? It is a measure of spread that investor would realize over the entire Treasury spot rate curve if the mortgage or asset-backed security is held to maturity. It is not a spread of 1 point on the Treasury yield curve as in the nominal spread. So it's not a spread at 1 point, but it is the spread that investor would realize over the entire Treasury spot rate curve, right? So the zero volatility spread is the spread that will make the present value of cash flows from the mortgage-backed or asset-backed security when discounted at the Treasury spot rate plus spread equal to the price of the security. So remember, we discussed this previously as well. So the spread required to make the present value of security under study, any mortgage-backed or asset-backed security, to the market price when we discount it at a Treasury spot rate. Obviously, is for the options, option bonds, embedded option bonds, and trial and error procedure is required to determine the zero volatility spread. So we will start with some spot rate curve, value the security, and see if its price is equal to the market price or not. And if it's, let's suppose, higher than the market price, so the calculated price is higher than the market price, we need to increase the spread. And if the calculated price is lower than the market price, we maybe need to decrease the spread, and we carry on until we get the value equal to market price. So the shorter maturity or average life of a structured product, the less the zero volatility spread will differ from the nominal spread. So if the maturity is shorter and average life of the product is shorter, the zero volatility and nominal spread will be the same. The magnitude of the difference between nominal and zero volatility spread also depends on the shape of the yield curve. So the steeper the yield curve, the greater will be the difference. One of the objectives of this chapter is to explain when it is appropriate to use the zero volatility spread or OAS. What we will be seeing is that if a structured product has an option and the borrower tends to take advantage of that option when interest rates decline, the OAS should be used. And if the borrower has an option but does not to take advantage of it when interest rates decline, then the spread should be enough. That's all about the basically the cash flow yield. In the next video, we will be focusing on the Monte Carlo simulation and option adjusted risk.